Okay, so good afternoon, everyone, and welcome to another training video. In today's video, we're going to be looking at a very popular phrase, smart money trading concept. So we're going to really be looking at it in, what exactly is smart money trading? What exactly it's? How do you really do it? The problem is a lot of people who claim to be SMC trader still approach the market as though it's retail. So what exactly is behind the idea of SMC? And what are the different comprising factors or the different components that makes it up? And how can you probably consider that or use it as a form of analysis? Okay. So in the best way I can define the idea behind smart money trading concept, it's just a style of trading. Now, if I were to ask you what are the different styles of traders, some of you would mention indicator-based traders. That means traders who look for opportunities in the market based on indicators. Then there will be price action traders, that's support and demand, the candlestick formation, setup, whatever. So traders who are looking at who simply base off their trading ideas, right? So the reason for buying or selling, which is simply based off maybe support or demand levels or candlestick setups. There are traders with those type of ideas who look at the market in those framework. So basically, different traders look at the market from different concepts, right? A price action based trader, you can call the person a price action based concept, a price action concept trading, right? Somebody who is, there are many people who are focused on indicators. They don't really look at the chart. They just have one or two indicators. If this is here and that is there, buy. If this is here and that is there, sell. If this thing change color, buy, or if that change color, sell. You know, all of those things. Those are indicator-based traders. They tend to make decisions to buy or sell an instrument based on what an indicator says. Now, I'm not going to sit down here and tell you that one is better than the other, although I have my preference and I have the ones I would never really use. But you can be profitable in every niche, in every of those different systems, if you stick to the rules. Like I keep teaching you in many of my classes, rule-based trading is the only way to make money. The problem is people just are all over the place. They are trading like this today. Tomorrow they are trading price action. Next tomorrow they are trading with indicator. And they are all over the place trying to make profits all the time, not understanding that in every single system, you have to trade it exclusively. You have to trade just it consistently so that you can be, if before you say it fails, you really have to trade it exclusively. And you have to trade it in the proper way, following rules. But people are just all over the place, and they are neither here or there. And even people who claim to be SMC traders are just retail traders, retail support and resistance traders with just SMC concepts, okay? So I would explain, the reason I'm explaining this like this is, so you know that it's not me saying one is better than the other. You can be very, very profitable if you trade just pin bars or engulfing candles at levels of support and resistance. You can be successful as a trader just trading one particular idea, but you have to stick to it, and you have to have rules as to how you trade, how you get in, how you get out, how you manage your trade positions, and how you manage your risk. Once you have all of those things defined, then you can say, I have a system. Now, the SMC concept, or the smart money trading concept, is about, instead of looking at indicator-based trader, is looking at the indicator, right, to make decision. A price action trader is looking at candlestick setups, so candlestick formation to make decisions. A retail trader, SND, that's a support and resistance trader, is looking at areas of resistance and areas of support or trend lines or stuff like that to make decisions to buy or sell. Now, obviously, in all of these systems, you might look for ways to confirm your entry, but that's the general idea. Now, the SMC, or the smart money trading concept, is actually, you're still going to be looking at the charts, but the idea, the real idea behind it is you are trying to figure out what the price would do or where the market would go by studying, by looking at and trying to deduce the smart money operators, basically their idea. So it's like this. Remember when we discussed Wyckoff, I mentioned the fact that, in the Wyckoff theorem, there's somebody he called composite man. And the composite man is basically, it's not necessarily one person, but it's just the power that be, the liquidity, where the most money is in the market and where they really want price to go, right? So if the market liquidity or the market makers or the composite man is looking to push price up or is looking to push price down, smart money trading idea is, which is basically how what Wyckoff is kind of like what all about, is saying, how do I get involved in the markets by following the signs left over by the composite man to figure out whether he wants to push price up or down, right? So that means we're looking at the smart money operator following the markets and trying to deduce an entry and exit based on the signs left to us in the market by the smart money operators. Now, basically, if there's one thing, if you've joined my classes, you know one thing I always talk about is the most important thing in the market is structure, right? Structure is the most important thing to me in the market, meaning you all have heard the statement, buy low, sell high, buy low, sell high. Now, it's a very common ideology, but common doesn't mean just because it is common, that means everybody knows it, doesn't mean everybody does it, right? Just because everybody knows that it is the right thing to not steal from somebody or not to, or to be kind or to be good. Everybody knows that. Does everybody do it? Well, few people do it. The same thing applies to buy low, sell high. If I show you any single market, you would notice that people are trying to sell at the highs and trying to buy, they're trying to sell a bullish market. They're trying to buy a bearish market. So instead of following the trend, you know that statement, the trend is your friend until it's broken. They're always trying to go against the trend. So your market that has gone up, they say, oh, this is a level of, this is too high, it has to go down. Let us trade it back to the moving average. It's going to retrace back to mean. All of those ideas, basically, they are trying to say, oh, the market is overstretched, it has to do this. The market has to do this. The market has to do this because they've seen it gone far. However, they'll still tell you the trend is your friend, and the market that is trending will most likely stay in that trend. So if a market is bullish like so, most people are trying to sell here. It's funny, but that's the truth. At this point here, most people see the market at this point. Everybody or most people are trying to sell this market to take it down. The question I keep asking myself then is why? But they say, oh, a trend, the market that is trending will stay, is most likely going to stay in the trend, or a trend is your friend. And everybody is trying to sell a bullish market. And what they keep wondering why the market keeps taking them out. And then when the market becomes bearish, everybody starts thinking, oh, this market has gone down too much. It needs to start going up. And everybody starts to try to buy here, only for price to continue to go down, right? Now, the idea behind market structure is very important. I think we've had a training on market structure. I had a full session on market structure and why it's important. Remember, like I mentioned, you can always get access to those classes if you have an account and you with ANZO, you can get access to the recording of those classes on the Google Classroom. Okay, so now based on my own explanation, or based on the way I look at SMC or smart money trading concept, it comprises of looking at the markets from an angle, from a perspective, right, of the smart money operators, and trying to figure out what to do or how to trade, whether buying or selling. Market structure is very important. So rule one, if the market is bullish, well, I want to only look for buying opportunity. This means that in no way am I going to try to look to sell this market in a bullish trend. The market, until I have a reason to sell the market, and my reason for selling the market has to be based on structure, right? So my reason for looking for buys or reason for looking for sell is dependent on the market structure. So if the market is bullish, now at this point, let's say this is a live chat. Many of you will be looking at this area and trying to sell, true or false? Well, if you tell yourself the truth, you know that that's true. Most people will be looking at this trying to sell. And the truth is, every once in a while, you make profit because the market will go down, right? And actually, in many cases, the market will go down and you should be able to probably make some profit. However, in most cases, what happens is the market will do something like this and then continue moving. And you keep wondering why your areas or your levels or your zones don't hold. Well, the reason is, well, look at this market, for God's sake. It's bullish. Why were you trying to sell, right? And then, you know what happens? Most of the times, instead of using stop loss, they'll probably look back 10 years ago and see that, oh, this is a strong resistance level. Price is going to hold there and it's going to sell. only for market to maybe do something like this and then continue going back up. And then they keep wondering why their village people will not let them be. Okay, so market structure is very important. The trend is your friend until it's broken is a phrase that you want to have embedded in your system. Okay, now structure of the market is one. What it tells us is what kind of opportunity do I want to look for in this market? And I look for buying opportunity in a bullish market. Okay, so we have that set. Now, the next point is, what areas will I be interested in looking for buying opportunity? Now, just because the trend is bullish doesn't mean, or the market is making higher highs and higher lows or an uptrend, doesn't mean everywhere is a good place to buy. For instance, just because I'm interested in buying this market here, because the market is, just because I'm interested in buying this market because it's bullish, doesn't mean that I want to buy everywhere I see. For example, I might not necessarily want to buy here, right? I might be interested in buying this market, but I'll probably want to buy at a reasonable price, right? So basically, once we've identified the trend, the next point will be what areas, which zones, which regions am I looking for opportunities to participate in this buy? Now, last week we discussed order block, right? And I also talked about imbalances in a bit. And I explained to you that when the smart money operators, many times when the smart money operators get involved in the market, what they do, because they have to buy to sell, they have to sell to buy, when they eventually begin to push price in a particular direction, they leave gaps and imbalances. And sometimes in quotes, the market, because the market usually tends to retrace to those imbalances to then continue to go in the overall direction. Therefore, those areas where there is clear imbalances provide us opportunity for potential retracement into a potential zone to sell or buy from. So once we've identified the trend, the next point will be to identify potential areas where price could pull back to before giving us the opportunity to get involved as a buyer or as a seller. Now, once we've identified that zone, let's say we've identified the zone as this area here, the next point will be to wait for price to get to this area, because just because we've identified the zone doesn't necessarily mean price must come back to those areas. Now, many people will say, oh, well, if we're expecting price to come back down here, why don't I get involved in a sell for price to come here and then, buy for price to go up? Well, it's just greed, ojukokoro, right? Now, while you might do that, and some trainers will tell you to do that, well, I usually tend to say, patience is the key. Don't feel the need to, the urge that you need to trade every single time, right? Many people have this addiction to trading, where they feel they have to, if they're not placed a trade for, if they don't place a trade for 2 hours or one day, say, it feels like the world is going to fall off. I've not taken any trade this week in the market, the whole week, because I've not seen, and I'm waiting patiently for the market to give me something that I like, right? Now, so once we've identified an area based on this smart money concept, so remember, we're identifying this area, not necessarily, no, we're not using Fibonacci to do that. We're using the same smart money concept in this thing, order block plus an imbalance plus previous, structural shift in markets. I remember that when I talked about, I think I have a training on multiple time frames analysis, that's the MCFA, where this bearish market here, or this pullback down here on a smaller time frame, would be a mini bearish market or a mini bearish trend, right? And then there would be some structural shifts from the downside to the upside to then give us an indication that price is now ready to move the other way. So point one, we look at the overall market structure, and then we want to trade in the direction of the market. Point two, we want to identify areas, potential areas where the markets could pull back to or pull back towards before we get the next continuation of the overall trend. And we're going to use, well, we're not using support or demand or supply or maybe indicators to figure that out. We're going to still use a smart SMC concept, in this case, order blocks, with leftover imbalances. And then point three would be, how do we confirm our entry? Because remember, I think in the last 2 weeks or 3 weeks videos, we also discussed confirmation, right? And I said, just because you have your first point is met, second point is met, third point is met. Doesn't mean you just place a pending order to buy or sell from a particular area. You can do that, yes, but personally, I'd prefer to confirm that area because, well, just because you have this area, right? Just because we're looking at this region here as a potential area where price would continue going back up from, the market could very well come back here and break through it. In which case, well, if you place the pending buy here, you just end up taking losses. However, what I want to do, or what I would like to do, is to look for confirmation within this zone. So I want to still confirm price within this zone so that when I get involved in the trade, my risk would be much smaller and my targets, at least my risk reward ratio, will be even better. So first off is identify market structure. Where is the market going? Once we've identified the trend, we want to look for opportunities in the direction of the trend. Second point would be identifying zones of interest, areas where you expect price to get towards before continuing in the overall trend. And then point three, look for confirmation within those areas or within that area. Sometimes it's multiple areas, sometimes it's one area, to then look to continue trading in the overall direction of the price to deliver to the next liquidity highs or lows, right? So basically in an uptrend, the highs are usually the liquidity areas, are the targets for liquidity. So if price is going from here, I'll be targeting this high because that's most likely where the liquidity resides. And then when that is done, look for the next structure to trade it, okay? So now we've explained the concept of what SMC basically is about. This is what SMC is about. What is there to get even better at trading is to now refine this. And this is where I come into play. My classes, especially the classes where we would have, like this one's on the live classes for clients only. Sometimes we would discuss core advanced concepts. I'll break this down into a much more detailed explanation for you. Now let's go over to the chart and see if we can spot a couple of examples explaining, putting all these three components we just talked about now into one example or a couple of examples. And remember, first point is figure out the market structure, then look for opportunities in that direction. The second point, we look for zones of interest, and then wait for price to get to those areas. If we get price getting to those areas, then we look for confirmation within that area to then move price or take price in our overall direction. So let's go over to the chart and see, look at a couple of examples. Okay, so now so on my chart here, I have gold. I have the chart for gold. Okay, this will not show a very clear example on exact delivery of what we just talked about, but it's a very good example of how you do those analysis. Now, I don't know, some of you who are on the Telegram channel for clients only, you remember that sometime, I think 2 weeks ago or thereabouts, a signal, I think it was on the 4-hour time frame. I personally sent out a signal, this is for a 1-hour time frame, looking for potential sell opportunities. So I was saying, well, I'm looking for opportunity to sell this market, but then I identified this area like so. Identified this area. So let me make this red. And also this area as potential areas I'm interested in selling from, right? Now the question is, why was I looking for selling opportunity? Well, also, if you're on the Telegram channel, you remember that we got involved in a buy trade somewhere around here. We got involved in a very beautiful buy trade that gave us, I think, about 1:7 RR on profits within here to this point, okay? Now, the question is, why am I looking for opportunity, or why was I looking for opportunity to sell from within these areas? Well, the market was bullish, and you can see the market was bullish. How do we know a bullish market? Well, we know it by the structure, where price is making higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. So price, when the market is resultantly making higher highs and higher lows, that is a bullish market. Now, price made this high. You can see higher highs and higher lows, and we expect price to make a new high. However, what happened? Price made a lower low. You can see that this low is much lower than all these lows. So what this tells me is the structure of the market has shifted from being bullish, because all the while here, I was looking for buying opportunities and I got involved in a number of beautiful trades buying. But the moment this happened, the structure of the market has shifted and I was only looking for selling opportunity. Now, when this happened, for those of you on the Telegram channel, you can go and check it out. I sent out a trade signal or a trade idea, basically highlighting these two areas, saying I'm interested in selling, but I want to wait to see if price gets here or gets here. So I want to sell the market from here or from here. This is why I talk about confirmation, right? This is why I like to trade with confirmation. So if price gets here, I want to see confirmation that price is ready to go down, because price could get here and still very well go up, in which case I want to see confirmation that price is ready to go down and then sell back down. Now, in this particular example, this is an example of, even though you got the direction of the market right, you don't make any money from it because you don't take any trade. So you can see that I was right about direction, in the sense that I expected price to continue to go down. However, the market did not pull back to the areas of interest I was watching for. And that doesn't, that is not bad. Don't go and start sweating about it and like, oh, I should have started selling from here. Because the moment you start trading without rules, that's where you leave yourself open to blow your accounts. Because people, oh, I'll sell here, and then if it goes up, I'll sell again. And if it goes, who told you that it's not going to now continue going up forever? So you want to trade in such a way that your risk is small and your potential reward is big, right? Now, so this is an example of planning your trades. You can see, so for those of you who were in the previous class, you can see that there was a leftover order blocks here and here, and those leftover order blocks were were followed by an imbalance. So you can see that there's an imbalance here. This big candles, there's an imbalance here that we're expecting price to probably come back and close those imbalances. But, well, it didn't happen, and price continued to go down. And this is one thing about following the structure. Now, many people, this is how they trade. They're like, oh, we're expecting price to come up to this imbalance or to come back and retest this area. So price, they'll try to buy here because, oh, price will go up here, right? So they try to buy here. And then as the market begins to go down, they'll say, oh, it has to come back up. They'll buy again here. And then they'll buy again here, only for price to probably maybe continue to go up, right? Now, this type of trading is how you blow accounts. People, I never met anybody who blew an account because they took a small loss. The reason accounts get blown is usually because of one stubborn trade. One trade where you're trying to buy and maybe take price to an area. You say, oh, if it goes up to 50 pips, I'll take profit. And then the market is going down. Instead of you to close it and take the loss, you keep holding on to the trade with hoping that the market will reverse. Sometimes not just do they hold on to that trade, they keep adding new ones. Then the market keeps going down and they keep hoping, oh, if this just goes back to break even, I'll close the trade. Now, trading should be objective based. It should be rule based. It should not be based on hope. Hope is not a strategy, right? When it comes in trading the market, hope is not a strategy. It is simply just bullshit, basically. It would cost you your funds, your hard-earned money, and probably cause you to lose quite a lot. Now, in this particular example, price didn't pull back to this area. But here is the thing, because I am following structure, well, this move is still bearish. So the moment price closed down here, right, you can see that price has made a lower low. I'm no longer interested in this too. I think in our weekly market outlook on Monday, I discussed that. I'm no longer interested in looking at these two areas because this is now the new high that I'm interested in, and this is the new low. Therefore, I have a new area I'm interested in here, and you can see it here. So let me just use the same. So, and you can see we have another leftover imbalance here, right? Leftover order block there that I would also be looking at. I was also looking at expecting price to get here and then go back down. Well, what happened in this case? Nothing whatsoever happened here. Price came here, did not pull back, right? And what happened? Price dropped again. So what is now my new area? This is now my new high, and this is the new low. Now, which areas would I am I interested in also? So this is an example of why I did not get any trade or place any trade this week, right? I was looking to trade gold and also Euro USD, but also I was actually quite busy and plus I've met my targets for the month, so I don't tend to overtrade. Now this is the area I was also interested in. You can see we have a leftover order block, right? And expecting price to pull back up here. Now in this case, all of these examples are not the best example. Like, well, I mean, not the best in the sense that price did not deliver to those areas as expected, right? But you can see price kept on moving in our direction. I'm very happy with that. Now let's look for an example of the total application of the SMC concept and how or what it would look like. Now I'm going to move up to the daily charts, right? And we are going to look at, let's look at Euro USD because there were a couple of trades in the past few months where we had just beautiful delivery in price. Let me take this off. Okay, so let's say we look at this. Okay, so let's now the idea behind what we're talking about can be applied on every single currency pair or an instrument on every single time frame, right? So it doesn't matter the pair you're looking at or the time frame you're looking at. Obviously, like I taught you, like I tend to say, you want to pay attention to the higher time frame, and the overall buyer should be based on the higher time frame perspective. I think I can spot a very good example here, right? Now, looking at this market has been bearish for a long time, right? We made a lot of money trading this one. Some of you in my classes, you'll know that for a fact. Now, bearish markets, because the market kept delivering lower, making lower lows and lower highs up until this point. At this point, we had the last lower low, and then price made a higher high. All these highs are just intermediate highs. This is the actual high that broke this high here. Now, from this point, those of you on the Telegram channel, if you go back, you'd also see my trade, the pictures and the images I left and the chart annotations. I was looking for price to come back down here or down here to get involved in a buy. Why? Because the structure in the market has shifted. The price get there? No, it didn't. And price continued to push up. Now, as price continued to push up, I actually got involved in I got involved in a buy here to then take price higher. But the question now I would ask, so let's delete this so you can see. Let me use my rectangles because I like to use those. So this was the original area. The structure. And then we had this structure here. And then I also highlight this one here. Right? Now, at this point here, I was interested in looking for opportunity for price to come back down here, right? Let me make that red as my zone of interest, or down here. Now, in this case, you see that price did not get down here. So what does that mean? It means, well, I'm done with these two. They are done. When price made this new high, I was looking for price to come back down here. Actually, the other block I found I think was based on the 4-hour time frame. So I was expecting price to come back down here. The price get there? No, we didn't get a retracement there. And so I was done with that. Now, we had this new low from this low down here to this high as a new structure. And then at this point, I was looking for opportunity for price I was looking for a buy opportunity around here. In this particular case, I got a beautiful trade. Now, if you go down to, let's look at the 4-hour time frame first and look at that area, you'd see why I was actually looking at that region there. So you'd see that we had, this was the zone I was interested in. Now, I'm not going to go into exact details as to why. You could see this last bearish candle before this big push up here. And you can see how price delivered exactly to this point here. Now, here's the thing, right? Here's the thing. I had this area. So when price was here, I had this area as an area I'm interested in buying from. So all of this time, I was waiting for an opportunity to buy. Now, when price got here, I got involved on this trade on a 1 minute time frame based on structural shifts within this area here, right? So based on the market, based on Wyckoff redistribution, right? Based on Wyckoff accumulation within this area, I was interested. That was how I got involved in a buy trade within this area. Now, I don't think the chart will go back that far, but let me try. Let me try and look at the 15-minute chart, see if it can go back that far to that area. Let's see. Okay, yeah, it did. So this was actually the trade for me, right? So notice how price got to this area here. And then remember, so when I taught you Wyckoff, what I taught you, I said Wyckoff is based, it's just simply weak to strong hand manipulation of price, right? When you see price get to an area, Wyckoff, it's accumulating buy, sells, what you tend to see after it has done the preliminary supply, the ST, the selling climber, the secondary retest, probably done a spring, right? A spring is where price pushed down below 11, right? And then push back up above the range. This is the SOS, so it shows the sign of strength, and then we look for pullbacks into previous order blocks before going up. Now, look at the schematics here. What do you see? Well, you can see we have our preliminary supply, our automatic rally, our selling climbers, our I'll call this another secondary retest, and then we had our spring. This is where you can see my drawing is kind of like obstructing everything. You can see that this low here, the market wicked down and grabbed all the liquidity below here. But that doesn't mean I'm interested in buying. The reason I started looking to buy is here when price aggressively went back above this range. And then you know what I did? I had confirmation that I was looking for, and I got involved in a buy trade. This was what my trade looks like. Buy. Now, why did I even buy here? Look at this. If you look at this, you'll see that we have another order block here, right? So we had this leftover order block here. Let me make that red. We had that leftover order block here on this smaller time frame, and what the price do? Came back down here, tapped into it. Now, this is a 15-minute time frame. I can't go back on the 1 minute time frame. It won't get this far. I got involved on this trade on the 1 minute time frame based on Wyckoff accumulation schematics within this area. So basically, it was just a weak to strong hand. Within this area I'm highlighting here, there was a weak to strong hand transfer, and I got involved in a trade with my stop loss. Actually, so this was what the trade actually looks like. So it was a buy trade. I got involved in a buy. My stop loss was something like this. Let me delete this. And what was my target? Well, where is the structure in this market? Where is the liquidity this high? So I got involved in a trade with that risk, right? And this potential reward. So this is what the trade looked like for me. So let me delete this so you can see. Let's delete this. Okay, so you can, this is what exactly it looks like, right? And you can see what happened. Now, this is what Wyckoff, or this is what smart money concept is all about. Looking at the market from the perspective of by trying to figure out or trying to see the hand. It's like, imagine you're playing card with somebody and you can look at their cards, right? If you can see that they have pick two or they have general markets, well, you would know what to give them next, So you're following, because they are the market makers, basically. You're trying to look at the footprints that they leave behind in the markets as a clue to get involved in the market, right? And so I did not get involved in this market because of any support or resistance or any price action candlestick setup or anything. It's just because I saw what I feel is an accumulation, and then from an area that I'm interested in, and I got involved in the trade based on my rules of trading. And this was a trade that had, in terms of risk to reward, right? Where is it? Yeah, in terms of risk to reward, it was about a 1:26. Now, it was actually about 1:25. And I did not take one, you know, I partial out. I have my own rules for how I manage my positions and took partial profit and all of those things. For example, I actually did take a partial trade. I actually took partial profit around this area, took another partial profit around this area. So at the end of the day, the 1:26 was something like 1:10, right? So this is basically the idea behind the SMC trading concept, to piece all of these three different things together into one component and use it as a reason to get involved in a trade by trying to understand the smart money operators, basically understand smart money concepts such as order block, Wyckoff, market structure, and then putting it together in one system based on your trading plan with proper risk management to give you an edge, or give yourself an edge in the market. Now, you can apply the same concept to everything. If you're trading based on indicators, you're trading based on price action setup, you want to build a rule-based system around it. So if this is what I look to get involved in a buy, this is what I look to get involved in a sell. If I find a trade that meets the criteria, then I buy. If I find a trade that meets that criteria, then I sell. Otherwise, you're just be playing with your money, right? And that's not healthy, right? And so this training now, it's just about a few of you guys here, but the truth is the wealth of knowledge that I just poured out here can change you as a trader. It's all down to you. You know, as a trader, I've been there, lost a lot of money. I've traded based on lots of system, traded without rules, without stop losses, and all the time when my account gets blown, it's because of stubborn, stupid trades, usually because I refuse to take a loss, and then I end up losing the whole account, right? But applying a specific concept to trading and being very, very precise about it, you want to be like a robot, taking unemotional trades with rules, based on rules. So if you build a robot, you just define a set of logic. And if those criteria are met, the robot will take a trade, irrespective of whether you're happy or sad, right? So it doesn't care about your emotion. It's just taking a trade based on rules. Now, if the logic behind the trade or the rules are wrong, it will lose a lot of money. But the problem is not the robot, it's you or the logic put into it. So in the same way, you want to be like a robot in the sense that you only trade based on rule. You're not trading because you want to make money. Oh, I've not traded today, or I need to make this X amount of money. And then you start looking for opportunities that are not there. You want to scan the market for opportunities. And then when you find those opportunities, you want to be like a robot. You want to be efficient enough to execute it without emotion. Okay, so I think that's quite a lot we've covered in this about 1 hour period of time. Let's call it 45 minutes. And I think it's a concept that could change your trading if you take the time to get better at it. Okay, so at this point I would stop the recording and then I'll take your questions if you have any. Okay, so remember, this video will be uploaded. The recording of it would also be available. So, but you need to have an account, ANZO, and for this particular one, you actually need to fund your account to get access.